Hey guys, Brent Richardson here. Thanks for watching. In this video, we're going to take a look at how a mortgage pre-approval in Canada looks. We're going to look behind the scenes. We're going to open up the software and we're going to see exactly how this is done. And I'm going to show you what I've learned in doing literally thousands of pre-approvals over the years, over the last 17 years as a mortgage broker and also a certified financial planner in Canada. So as we go through this application, this example application in the software, you're going to learn about what it takes to pre-approve a mortgage. Very high level, we're going to be looking at down payment. You know, that's the first pillar, if you will, of a pre-approval. We're going to be looking at credit score and existing debts. That's kind of one other pillar, that area. And finally, the third pillar is income. So we're going to see how all of these three pillars work together to create a pre-approval. And then I'm going to answer your questions, the top questions that I get asked on a weekly basis towards the end of the video. So relax, hopefully you enjoy and learn lots. Let's jump into the software. Okay, so here we go. We're in the application now, and as you can see, there's a lot going on here. First of all, this is a fake application. It's a generalizable example. It's not a real person. And there's a lot of different fields here that won't apply. So I'm going to focus in on the fields that matter and show you how a pre-approval is put together in the software to really help you break down in a practical way how this works. And so we're going to start off by looking at down payment and savings. So typically when a bank or a mortgage broker gets an application, there's data that's pulled over either from an online application or existing banking information. It's pulled over into the mortgage software. And so we have a bit of a starting place. So we're gonna look at down payment as the first pillar. How much is available? So in this case, we're looking at assets. And these clients, Mr. and Mrs. YouTube, they've got $5,500 in checking accounts. They've got $35,000 in an RRSP at Questrade. They can use the RRSP home buyers plan to cash this out tax free. And they've got looks like they've gotten started on an FHSA at Scotiabank. And so this is what we have for down payment. There's $50,500 available in total. So this is what's there now. Maybe they've got some extra that was not entered here, but you know, the more we can see, the better, of course. You've got about 50,000 to work with right now. So that's really pillar one. How much down payment is available? The other acceptable thing to use is gift. So sometimes family will gift down payment, should be immediate family, although there are programs out there where friends can even gift down payment. They're few and far between, but it does exist. So down payment's the first thing to look at. We've got that in the software here. Moving on, we need to look at credit. And so that's liabilities. And when you pull the credit score, I'm going to show you what the credit report looks like in just a sec. It pulls the information into the software here from the credit report. So in this case, our clients, the YouTubes, have it looks like a Visa with a $10,000 limit and $4,500 balance right now. There are two car loans, both they started at $30,000. This one only has $2,500 left, and this has $25,000. And then there's a student loan here with $35,000 left on it. And so there's a few debts here, and this is factored in to what's called the total debt service ratio. The total debt service ratio, the reason this is so prominently up here is this is a number we're going to be looking at for the pre-approval, and it does take into consideration existing debt payments. So keep this in mind. This is debts. As far as a credit report looks, here's what a credit report looks like. This is not this is not a real credit report. This is just a document I've typed up, and that has some information that resembles what a credit report that a banker or mortgage broker looks like. It's not 20 pages, and it doesn't explain at length what's going on. It's almost written in a code, but at the top it says the score. It confirms if the birth date's correct, if there's a mismatch. Things like if there is a potential for fraud, if there's scales for bankruptcy and other indicators going on based on credit behavior. The main thing is looking at the different credit lines, so the different components of the credit. In addition to the score, that's obviously a main thing. In this case, the client's score is 695. Now, looking at these cards, there is a bit of a concern here. We see all ones. This means, for every month, the credit's being paid on time. There was a period for this individual where payments were missed. So a lender's going to ask, what happened at this time, going back a few months, what happened where these payments were missed? So maybe there was a switch in jobs. Maybe there was, a health issue. Often there's a reason where, when we see an isolated incident such as this, it's not continuous, repetitive, missed payments, but that we can explain it to the lender, and the score is, it's lower than 700 here. It's being affected, but it's not bad either. So we're looking for a credit score above 650 as kind of a minimum. We're also looking to see a score above 680 to really get the lowest rates. And so at 695, this individual's fine, even though there was a missed payment here. Maybe there is a couple going over the years missed payments. But if we can explain this as an isolated incident, then it should be okay. Ideally, there's no missed payments. And even if there is several instances of missed payments going back over the years, as long as there's enough time from the last missed payment to today, the score should rebound. You should at least get over 650. Maybe circumstances have changed materially. You're in a different position, and so maybe the score is 655, but we can explain it in a way that there's a reason why it was low, and a lot's being done to improve the situation. So that's credit. In this case, it's fine. There's just a few things pulling through here onto the application that is going to be affecting the application. So as we're about to see in a sec, as we go over to income, employment, this is the third pillar. So far, the down payment checks off. So far, the credit checks off at 695, like we saw. It's above 650 and certainly above 680 to get those nice low rates. Now income. So what we're looking at, is it full-time or is it part-time income? In this case, it's full-time. Looks like a grocery store store manager in this case. Been working there for 3 years. We need a minimum of 3 years employment history. If you're brand new out of school, that's fine. We can work with, a year or even 6 months, but we need a good explanation why it's being limited work. We can use part-time work as previous work, but we need a 3-year explanation what's been going on. In this case, this person's been working as a store manager at a grocery store for 3 years, so we're good. We don't need any more history, and it looks like there's a base salary of $75,000. Now, if it was hourly, then, do these hours fluctuate? Is it 10 hours one week and 50 hours another week? And, maybe some weeks, if not needed, there's almost no hours. It's different if it's a salary. We can actually just go based on this income, or very close to salary, almost the same as guaranteed minimum hours. If the hours are guaranteed at a minimum, this means there's basically a salary that we can project. if the hours are not guaranteed, we have to put in hourly and explain, hey, we have 2 years. We can show, 2 years, last year and the year before, of an income average to support, this income. In this case, it's a salary. We don't have to do that. And in some cases, maybe he works at the grocery store, but sells memberships at a grocery store or something like that, sells cell phone subscriptions at the grocery store. So that would be a commission income, and in that case we definitely need 2 years to average the income, because we don't know on a week to week or a month to month what the income is. But 2 years will give us a pretty solid idea. In this case, it's salary though, and it's the same for Mrs. YouTube here, also on salary. There's 5 years as a teacher here, so here's the salary. So we're good to proceed with these incomes, $150,000 of income. Now, as of right now, we have the 3 pillars. They're all looking good. We have the down payment at just over $50,000. We have the credit score. The credit scores, in the case of 2 people, are looking good. There's some debts in the picture that we're going to see affect the application in just a sec. But we have salaried income. Nothing in life is ever guaranteed 100%. But when there's a salary in place, that's typically reliable income that we can work with. And so in this case, there's also a Canadian Child Benefit. So they actually have 2 kids. Up in the application details section, there's $200 of child tax benefit. So we can use the Canadian Child Benefit in the application. Sometimes this is forgotten, and it can be the difference of getting a property, that extra $10,000 of a pre-approval or not. Sometimes this amount is less, sometimes it's more, sometimes it doesn't exist at all, of course. And so we want to make sure we can use every bit of income that we can when we're pre-approving. Again, we're seeing the savings here for the down payment. We're going over this. We're going to flip to a different part of the application now, which is the mortgage. So when we get the application, we see all this stuff. We're going over it. Yeah, it checks out. It's looking good. Now we need to enter things like, the rate, things like how much house are they looking at? What's the target price range? So let's just say they're searching around MLS. These clients are looking in the $750,000 price range. We know how much down payment they have. They're looking around the $750,000 price range. I know that some of our lowest rates today are 3.99%. So I've entered that. I've entered that's a 5-year term, a 25-year amortization. It's a fixed rate. So I've kind of plugged in these. Here's a big one, the qualifying rate. So the interest rate that you qualify at is actually 2% higher than the actual interest rate that the homeowner, the applicant would see on the application or on the approval. We're qualifying 2% higher. This is the stress test rate. This is super important, and we're qualifying at a 25-year amortization in this case. So let's go up. We've got $50,000 of down payment to work with. Let's use a $750,000 purchase price. So the minimum down payment in Canada, it's 5% of the first $500,000 of purchase price. So 5% of 500,000, that's 25,000, and any purchase price above 500,000, that's a 10% down payment. We look at that differently. So 250,000 more than 500,000 is 750,000. That's where the client's kind of looking, that's kind of their goal. So 25,000 on the first 500,000, 10% of 250,000, that's another 25,000. So we have $50,000 of down payment that we're working with here. Whoops, that's not 50,000. There we go. So that's actually the minimum down payment for $750,000 is 6.67%. The mortgage, pretty easy math, $700,000. But because this is less than 20% down payment, there's a CMHC insurance premium that is going to be added on to this. And so that insurance premium, the software is going to know what that is. We're going to calculate this out. We're going to get the software to figure this out. Okay, so that's a $28,000, the premium with this down payment, CMHC 4%, that's $28,000. So we've actually added onto the $700,000, we've added $28,000. So it's actually a $728,000 mortgage, even though with a $750,000 purchase price should just be $70,000, the insurance premium boosts it up. So we're getting the payment here, and based on a monthly payment, if we wanted to do biweekly, that would change this. It would lower it, and the other thing we can do is play around with the amortization. So it looks like we're going to have to do that. This number here, total debt service ratio, TDS, needs to be below 44. This GDS needs to be below 39 for an insured mortgage. So this checks off. This is below 39, but this is a bit high. So we're going to turn this into a 30-year amortization, because first-time buyers now qualify for a 30-year amortization. That's a new government rule that came out. We're going to recalculate, what does this do to the total debt service ratio? So now it's under 44. Okay, great. So it qualifies. You'll notice this premium, it actually increased a little bit. When we went from the 25-year to the 30-year, there's a slightly higher insurance premium. So maybe that's one thing to discuss, is like, are you okay with this higher premium to get to this higher price point? But we're not done yet. The other thing that goes into this GDS and TDS, taxes. So the taxes vary depending on the city, but let's just say it's approximately a $5,000 to $6,000 property tax. We want to err on the side of caution. If it's $5,000, if we enter $6,000 here, we've covered $5,000 for sure. If it is $6,000, then at least we've managed the pre-approval properly. And for heating, this is kind of a low-ball amount, but an amount that will likely be accepted by the insurer, is $100 a month. So now that we've entered these expenses, we have a full picture of this total debt service ratio and this gross debt service ratio. And so we're going to recalculate based on this. And so as we see, even with the 30-year amortization, this is over 44%, and the CMHC will methodically decline this if it's over 48%, if it's over 44%, even though this fits under 39. So to come up with this debt service ratio, we're using the mortgage payment, we're using the property tax, we're using the heating, and we're also counting in all the other liabilities. So if we go over here, we look at these payments. These are affecting the total debt service ratio. It looks like this car loan, it was $30,000, but it's down to $2,500. If the client can pay this off, maybe over the next couple paychecks, maybe there's a family gift, if the client can pay this off, then we're paying this off before closing. It doesn't have to be paid off today, but we make an agreement that before closing, this $2,500 car loan is going to be paid off. We're going to recalculate this total debt service ratio, and now this number's in line. So we worked with an existing debt. Now this car loan, $25,000, that's obviously not as easy to pay off as $2,500. Even though this is a bigger amount, the way they've structured this loan is the payment's lower. It really only comes down to what the payment is. This student loan's $35,000. but the payments can be very lenient. They're only $150 a month in this case. So it's not the size of the loan, it's the payment. And we can work with these. Sometimes there's more down payment, and I want to make a 10% down payment, but I have this credit card or I have this loan. Well, maybe we take some of that additional down payment, we go to the minimum down payment, and we pay off the loan. Now, it's not always about how much, what's the maximum pre-approval. Often it is when people are starting out, when homeowners are trying to get into the market, it is harder. So we're often trying to stretch. We're often looking for strategies. How can we structure the application to do this? Ideally, though, what we're doing is we're looking at, what's the optimal payment. And so, maybe at the beginning we say, well, what's price range are you comfortable with? Or are you looking for? And $750,000. Okay. Well, what payment are you looking for? Oh, I'm looking for no more than $3,000 a month. That's within our budget. We want to travel too. We have some other things we want to save. And so this, even though we've got the application working, this is $464 above their minimum comfort level. So what would work? We've got to adjust the amount. Maybe it's $700,000. We're going to recalculate everything here. They've got $50,000 for down payment. We're going to recalculate. What's a $700,000 purchase price? So we're getting there. We're closer. $600,000 mortgage. Okay, so now we're under $3,000 per month. And so, if this is the comfort level, there's more room. We can go to 44 here, we can go to 39 here, but based on a budgeting perspective, maybe a $650,000 house is the right way to start off. That's a completely different house than $750,000, but this might be the best way forward if it's possible for our client here, for the applicant, to find a house in this range. Or maybe maybe they stretch a little bit over. Maybe we go to $700,000. So here's a behind the scenes work. There's I should say. There's a lot more detail. It's almost like a puzzle, as you can see. There's a lot more strategy that can go into this in looking at these three pillars, but this is the main this is the gist of it that I've just explained. So from here we're gonna go out of the application. We're gonna look at the main questions that people have when getting pre-approved. All right, so here's the top mortgage pre-approval questions that I get on a weekly and sometimes even a daily basis. So what's the difference between a pre-approval and a full approval? So the pre-approval is basically done before we have an offer on a house. So we don't know what house you're going to buy, but we have all the other information. We've got the income, we've got the credit, we've got the down payment information, and so we know that the math works. We know that a lender we meet the lender guidelines to buy a house, but we don't know what the house is. And so when there's an offer to purchase a house, we take that house information, we enter it in the application, and we send it off to the lender. And so the application turns into a full approval once the lender says yes based on that house. If there's something wrong with the house, if the listing says that the kitchen's gone or something, or that the house is under construction, the lender might take a look and say, do an appraisal to say, sorry, everything looks great with the pre-approval. We like the application, but the house doesn't fit. So it doesn't guarantee that the house will be approved, but it is the best first step the real first step into going into buying a house. If at all possible, a financing condition's always recommended to go from a pre-approval to the full approval before there is no conditions, before you're firm and obligated to proceed with that purchase. So what are the pre-approval risks? So the risk is if you don't have a financing condition when you make an offer on a house, and it's firm and binding as soon as you sign it. There's no getting out of it. Well, what if there is a problem with the house? What if something comes up and I mean the income that we thought was a salary, the employer says no. Well, if you thought, you might have thought this, but it's actually hourly and it's actually variable hours. So we entered salary, told the lender it was going to be salary, but now the employer is saying no, it's not. So again, kind of far out, but in all the thousands of applications, this kind of thing has happened. It has happened that there's issues with houses. It has happened that there's discrepancies with, minimum pay on an official level. So in order to mitigate or reduce these risks, we need to get the documents up front. Get an employment letter from the employer, obviously, that says this is full-time salaried. It's not hourly. It's just a one-page thing. It's not the full employment contract, but getting that employment letter, getting a recent pay stub is the second biggest thing. And this takes care of income. If there's an income average over 2 years, we'll need 2 years T4s or 2 years notice of assessments that we can average income with. In any case, getting those income documents up front, seeing the money in the account, getting the account information. We need 90 days history. There's a massive deposit 3 days ago. Well, where's that money from? Oh, my friend gave it to me. Well, or it's a loan. Like that might not work. That probably wouldn't work in the case of a loan, especially. We need 90 days history. We need to be, very much squared up and sure that the data we're entering in this application is what the documents are going to show. So if we can show that these documents are okay, that they align with the information that's entered, and also if the MLS data, if it's saying the house is in great condition and the pictures show it's move-in ready, this and you have a financing condition is probably the most important thing. This really limits the risk. You can go from a pre-approval to a full approval, and I've never had a mortgage that hasn't closed in all the thousands of pre-approvals and thousands of closings. I'm very thorough on making sure these documents are done up front. We have to get the documents anyway. Why not get them up front and do a really thorough job? If there is something that comes up that looks a little off, at least we can reconcile that up front before the lender sees it. We can deal with it and make sure the pre-approval is strong and bulletproof, if you will. How long does a pre-approval last? So the short answer is it's indefinite. It can last for months, 4 months, 6 months, a year or more, as long as there's no major change. So if you're pre-approved and there's a job loss and maybe the new job is $10,000 less, well, that's going to change affordability. That's going to change the pre-approval amount. So that kind of thing has to be entered. If there's no job change or maybe there's a raise, well, your pre-approval may go up. The amount you're pre-approved for can increase. So the answer is indefinite without changes. But if there is a change, this needs to be factored into the pre-approval for it to remain reliable and accurate, is the main point there. What's the difference between a mortgage rate hold? How long does the rate last when I get pre-approval? That's called a rate hold, which is technically different than a pre-approval. The pre-approval is that exercise that we just saw where we go over the down payment and the credit and the income, whereas a rate hold is we actually send that off to a bank, that information. The bank says, yeah, we agree this information looks good, we're going to hold a rate. Now, the rate hold is usually a bad rate. It's usually, maybe 1/4% or even 0.5% higher than the lowest rates we can get at the time. And so, does it make sense to go off and get a rate hold if it looks like rates are going down? Probably not. However, if we're looking at bond yields or looking at the financial markets, if it looks like rates are going to increase and increase a lot, well then, yeah, we want to get a rate hold. And so we wait until the right time. Maybe it takes 2 or 3 months before rates threaten to go up. Well, we wait until that time, until that threat is there, then we get the rate hold. This buys you more time at the lowest rate of the day. Otherwise, if there's no real threat of rates increasing, we monitor the markets. We encourage all the documents. We encourage a financing condition if you do make an offer to protect you. And the rate hold, 90% plus of the time, doesn't even come into the picture. It's only when it looks like we need to protect your rate. And even 1/4% higher rate today might look really good 3 months from now. We want to get that rate hold. So there's the rate hold. That doesn't mean you're pre-approved, and there's the pre-approval. That doesn't mean you have a rate hold. You can do a rate hold and a pre-approval. Those are two separate things. Often they're done with a bank pre-approval letter, but that's not always necessary. It's not always needed. As I say, the main thing is financing condition, the documents, make sure everything lines up. We've reviewed it once, we've reviewed it twice, and never seen a problem with this level of detail and care on an application. So that hopefully gives you a really good idea, an extensive idea of what goes into a pre-approval. Happy to answer any questions. Feel free to make a comment here in YouTube, or reach out to me at Altrua Financial, and let's talk about your application, your unique circumstance, and what you're looking for. And I look forward to that conversation if you reach out. Thanks so much for watching, and I wish you a good day.